if you want to trade with confidence and stack the odds in your favor, here's a high probability trading strategy. So step 1, identify the main trend. This is on the 4-hour chart. So that's the sweet spot for traders. It's not too slow like the daily chart, but it filters out the noise from the lower time frames. So to trade with high probability of success, you need to be aligned with the main trend. That's the key. So check the market structure. Is it an uptrend? Is it a downtrend? Or is it a range? If you can clearly see the sequence of highs and lows, you already have a strong read on the market direction. But otherwise, you can just put on the 200 EMA for a quick visual confirmation, and that will give you a good idea of the trend. So here we see the euro yen's in a downtrend, and even if we were to put on the 200 EMA exponential moving average, that should show us the same thing. So 200 exponential slanting down. So currently towards this right hand side of the chart, we are in a downtrend. Step 2 would be, we've identified the main trend on the 4-hour chart, which is down. Now on the 1 hour, we're going to add the 30 period exponential moving average and the 120 period exponential moving average. So the 30 period is our short-term momentum tracker, and the 120 is the equivalent to the 30, but it's on the 4-hour chart, since obviously 4 times 1 hour candles is 4 hours. So why are we using the 30? This reacts quickly to price movements, giving us early indication of setups, and the 120 keeps the higher time frame trend in mind, even on this lower chart. So how do we actually use them? So I'm going to talk about in a downtrend, because obviously the overriding trend is down, but obviously the opposite is true for an uptrend as well. So in a downtrend, when the 30 crosses below the 120, this confirms bearish momentum, meaning we can start looking for sell setups. This is a multi-time frame approach, and so that ensures that we only trade in the direction of the dominant trend, increasing our probability of success. So step 3 is we wait for the pullback to the 30 period exponential moving average. So just because we've seen them cross over, we don't just get in immediately. The highest probability entries happen when price pulls back to the 30 and obviously in the trend's direction, which we've already assessed is down. So now they've crossed, we're waiting for it to pull back. And why? So, people just get in when they see a cross. There's 3 reasons that we actually wait for it to actually pull back to the 30. It acts as dynamic support and resistance in a trending market. It avoids chasing the price, so we're entering at a better price instead of, fear of missing out type trading. And the other reason is it provides confirmation, so we wait for price to react at the EMA rather than guessing. So to find the best entry zone, you could just enter off the 30, but that is a little more risky. If there are confluencing factors like key support and resistance levels, order blocks or fair value gaps, a Fibonacci retracement or rejection wick or some kind of candle pattern, that is definitely helpful. But yeah, sometimes I just get in straight off the 30, but that's slightly more rare. The best setups would always be the first pullback to the 30 period moving average after the cross. They're usually the highest probability ones. So yeah, executing the actual trade, you enter once price confirms the rejection of the 30. You put your stop loss above the entry zone for protection, beyond the slower moving average, so above the 120, that would mean in this case. And your take profit would be the next key level. So patience really is the key here. You're going to let the market come to you. You're not going to force trades. So just as another example here on the pound dollar, you've got on the 4-hour chart. Remember, that's where we make our overall assessment or gauge the sentiment. So what we can see is an uptrend. So now let's go down to the 1-hour chart. So down here you see the cross of the 30 over the 120. So that's in the direction of our trend, which is up. Now the first pullback, it went straight through. Probably would have taken most people out if their stop losses were there. But the subsequent pullbacks to the 30 period moving average would have resulted in some good trades there. And obviously up here you see it crossed back over, but remember that would be against our main trend on the 4-hour, so we wouldn't be looking Now that it's crossed back over, that's another alert. It's in the direction we want. So we'll be looking again for these high probability trades. So yeah, by following this approach, you're not just trading randomly, you're aligning yourself with higher time frame trends, refining your entry and waiting for the best pullback opportunity. Keeps you on the right side of the market, minimizes risk, and yeah, it's basically a high probability trading process. So just to recap, step 1 is identifying the main trend on the 4-hour chart. Step 2, you drop down to the 1 hour with the 30 and 120 period exponential moving averages crossing over to give you your initial alert. But obviously remember, you don't jump in. Step 3, you're waiting for the pullback to the 30 EMA. If it's at key level or some kind of candlestick or rejection, even better. And yeah, that's how you trade with confidence and precision.